Good evening. Welcome to Money Matters. I'm Charlie Shields of Wells Fargo Advisors, member SIPC. My co-host tonight is Pat Dunn, who's a senior VP at Merrill Lynch. And there's so much going on in the markets these days, we're going to skip the special guest tonight because we want to talk to you for 30 minutes about what we think is going on and try to help you through some interesting times, as the Chinese curse says. Well, Pat, thanks for being here. Good to see you again.
Good to see you again.
Yes, indeed. So let's start by talking about this Department of Labor since the election. I don't want to time the show because of the fact we're taped at different times in different places, but since the election was over, there are stories every other day that they will cancel DOL rules or they will keep them in place. Do you see any impact either way as far as your business is concerned?
Actually, it's been very beneficial for my business. I lead a wealth management team, and it's actually driven clients up the food chain to the personalized service of wealth management. So it's been very positive for us.
Good.
But you're absolutely right. Every day it's a different story. Is it going to be delayed? Is it going to be canceled? Is it going to be modified? Nobody knows. At this point, it is really too late to do anything through the courts. And it's been put back into the hands of the DOL to see if they can get through in the next month or two some modifications. But understand they started working on this in 2010.
Sure.
And
A lot of hard work behind this already.
An awful lot of hard work. There's been 3 court cases where it's already been upheld that the DOL regulations will become law. So at this point, I don't think there's a whole lot that can be done. Yes, it might be delayed, but I don't see it going away. I think it is the future.
And, you know, when you read through it, there's a lot of good ideas in there saying be sure and take extra special, good care of your clients. And I can't find anything wrong with guidance like that, right?
Absolutely.
Okay, terrific. Well, there's a lot of possibilities going on in Washington now, and we're hearing all these huge changes that they're going to be trying to make kind of all at the same time. They're talking about tax cuts, and that's a process that takes a while and needs cooperation of both sides to really get it through in a sensible way. We're talking about terminating Obamacare and putting something else in place. And I've heard even our new president say that that might be a 1.5-year process. I personally think that's good news if they're going to move fast slowly on that one, so to speak. And we've also heard about a lot of reduction in paperwork, which should be good news for small companies and middle-sized companies. Some of the bigger companies can hire bureaucrats to keep up with the paperwork, but the small companies cannot. So what do you see happening with all this turmoil in Washington? Do you think it's going to affect the markets a lot, or what's your outlook?
Actually, I think you hit on a very good point there, Charlie. Investors don't like uncertainty, and turbulence spells uncertainty. The investors clearly have shown us with the rise in the market that they like the pro-business stance of the current administration. But the turmoil could lead to a potential headwind.
Sure. So we'll have to watch it unfold, and I almost sometimes think it's backwards from what I suggested, that you can watch the stock market and figure out how things are going to go in Washington, because people are voting with their money in the stock market. And so far, without timing it, the market hasn't suffered any real sharp declines during this transition period. And perhaps the market is figuring out that as they work through these things will come out okay.
I think so. We have a couple of things in our favor. We do have a strong employment rate. You know, there's been an awful lot of jobs, and that's been fueling things. At the same time, we have a couple of headwinds, and that is we're still dealing with a rising dollar. We're dealing with rising interest rates, which is shifting where in the market you're going to get your best return. Energy prices up or down, but generally tending a little bit higher. And we're thinking that there's going to be a slowdown in China, which could affect Asian markets. So there's a lot going on at the same time.
Well, your comments lead us to the subject of inflation, and obviously if higher wages are starting to occur and someone is working very hard and has a lot of talent and they're not being treated right, they'll be able to start moving to another firm, and that could create some wage inflation, at least up in that upper to middle level where people have some real skills. So what's your outlook for inflation?
Actually, I see inflation coming in. It's interesting, 12 months ago we were dealing with a deflationary environment.
Sure.
But now with, as you pointed out, the labor market getting stronger, people moving to where they're appreciated better with dollars in their pockets, and interest rates rising, all of that spells inflation. We're going from a deflationary environment into an inflationary environment, but it's a matter of degrees.
Sure.
I don't see us doing a 180 from deflation to high inflation. I think what we're seeing is a trend developing.
A choppy process perhaps, but a slow change. And to me, deflation is a lot worse than inflation. So I think it's good news if we're starting to see whiffs of inflation.
I absolutely agree. Whiffs of inflation is good for business growth.
Okay. And going back to the oil markets and gold and bonds, again, you could also say that perhaps people putting their money into those commodities and into the bond market are a good indication of what's going on. It's kind of the backwards way of looking at it again, that if the markets are starting to have higher gold prices, higher yields with bonds, if oil prices start to rise, that is a clue that we're going to see some inflation. And I will suggest to you that you don't have to have 5% inflation. If the market was expecting 1.5 and a year later you're getting 2.5, that's a big percentage change, and that can worry some people and cause gold to make a pretty good move. Yes. So I'm watching the gold market, the oil prices, and the bond market to tell me how much inflation's coming back. What's your thought on that?
I agree. I agree. Those are the three key points that you want to keep an eye on.
All right. Now, a lot of my clients say they get confused about a discussion, value stocks, growth stocks. Can you explain to our viewers and listeners what the difference is, and do you favor one side of that or the other?
Very good question, because we are at a transition point here. As I pointed out, a year ago we were in a deflationary environment. We had very poor corporate earnings, you know, they were all held down. And in that kind of environment where you're scratching the surface trying to grow, growth stocks tend to be the leaders. Conversely, as you start to get into an inflationary environment and interest rates start climbing, that's when it shifts to the value play.
Okay.
And so, whereas last year growth stocks led the market, I think this year value stocks is where the value is. Oh, that's a terrible pun, but yes, I think that's where the action's going to be.
All right, good. Okay, well, so then there's a couple ways you can skin that cat. So do you try to hire managers that are either value or growth managers, or do you try to hire smart people that know how to shift subtly between value and growth? How do you play this?
That's a very interesting question that we talk about every single day on our team. And what we've decided to do, because of the turmoil happening in Washington, and we don't know how much of a headwind that's going to be, we are trying to tilt portfolios towards value. Okay. Because clearly in the last few years, it's been our growth managers that have been the engine for appreciation for our clients' assets. So now it's time to start introducing more and more value. I don't see going whole hog from growth to value, but let's start tilting the portfolio towards more value.
My favorite situation is to have a client with half or a lot of their money in tax-deferred accounts and a lot of money in taxable accounts. And that way, when I want to make a shift like that, I can try to focus it in the IRAs where it's tax-deferred and not create a lot of capital gains. And sometimes when I feel real smart about a manager I've hired, I've learned to take some money off the table because I might feel dumb a year later. Because whatever is leading the pack, if they're all good managers, it's probably a good idea to rotate some money out of the one that's looking good at the time into the manager who's good but is performing more poorly.
I couldn't agree with you more. The ERISA law that came out in 1974 that allowed us to have IRA accounts was such a gift for the individual investor. And we've reached a point now where there's, as a nation, we have more money in retirement accounts than we do in personal accounts. But that ability to have the flexibility to change with the times and the market in a retirement account, which is tax deferred, and avoid the capital gains, has been a real plus for the investing public.
Good point. Well, there's some of our viewers and listeners who are scratching their heads, how can I do this? And hopefully they'll hire some smart people as their investment advisors to help them with this. But if not, there are core managers who have some growth and some value, and for people that are going to be do-it-yourselfers, that's one way they could go.
Absolutely. And now with the DOL regulations becoming law, we're going to see the emergence of a whole new segment of our industry. The concept of the robo-advisor coming online, and the robo-advisor will only operate in the core space. And then beyond the robo, if you want to work with a human being, there's going to be generic advice through call centers. And those humans, that's the first time you speak to a human,
Yeah.
their only opportunity is to give you core holdings that will balance the growth and the value. And it's only when you get to our level, Charlie, you and I, where we can actually sit down with a client and personalize a portfolio that is not just core, but also satellite, where we can try to match the client's risk tolerance and appetite with their goals and be able to have them have some managers, as you say, that will outperform in an up market.
And like you say, and as both of us do, we call our clients in October and say, hey, there's a lot of capital gains being spit out by this mutual fund or that. Let's go in and look and see if we can find some offsets to that. And robo-advisors are not going to call you up in October and say, watch out for the capital gains. You'll just get them dumped on you when it's too late, when you get your 1099 into the new year.
But conversely, Charlie, they're very inexpensive.
That's true.
And the level of service is commensurate with what the client is paying for the service.
Good thought. And we like to be fair and balanced.
Absolutely.
All right, good. Well, let's talk a little bit more and we get into a viewer question. Do you have any opinion on Asia versus Europe? Are you focusing international money in one area versus another? Or are you just hoping that the managers you hire are smart enough to know which countries to invest in?
Well, I do rely on the managers to pick the countries, but because we're expecting a slowdown in China, I do prefer Europe over Asia.
Okay.
Right now, how do you feel?
Well, I agree with you. I think a lot of times things are priced in already where maybe Europe is a little bit cheaper than Asia is right now because people have thought Asia was going to be okay, but if China sneezes, the rest of Asia catches a cold, and China's got some issues right now. And so I think you can get some real bargains in Europe, but like you, I don't try to go do my research over the weekend about different countries and stocks within countries. I leave it to some experts to do that. I focus my own research on U.S. stocks. Well, let's try to help one of our viewers. We had Thomas Williams of Newtown Square said, are raw materials due for a rebound? What's your thought?
Thomas, that's a very good question because that goes directly to what Charlie and I were talking about, which is inflation now versus deflation a year ago. And raw materials are commodities. And commodities have done extremely poorly over the last few years, and that's because we've been in a deflationary environment. We've been experiencing falling interest rates, and all that came to an end in July of 2016. That was the bottom of a 30-year decline in interest rates. And from there we started to climb, and this year the Fed's talking about 2 or 3 raises of the rates. That's an environment that is conducive to inflation and beneficial for raw materials. So as I've told my clients all along, it's not a question of if, it's a question of when. And I think the likelihood is pretty good for improving prices for raw materials, aka commodities, in 2017.
Okay.
You agree?
I agree, and so back to what we said earlier, our viewers and listeners can watch gold, they can watch oil, they can watch interest rates, and help them to anticipate how strong inflation might come back, how much these types of prices are going to go up. And you can be careful because some steel stocks have gone up 5 times in the last year. So don't say, oh, okay, these are all going up, and run out and buy a stock that's gone up 5 times in 12 months and could have a big correction and still be in an uptrend.
Oh, because they don't go up evenly. They go up in fits and jerks, and you don't want to get the guy that's the highest.
Right, good advice. Okay, we're now going to show you how to send in a question, and we'll have a videotape, and we'll be back with you in about 30 seconds.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Okay, when we stopped for a viewer question, Pat, we were talking about Europe versus Asia, that type of thing. There's another way to slice and dice the world, and that is developed markets versus emerging markets. Do you have an opinion on which of those might do better? And again, you hire your managers based on that opinion.
I hire the managers based on that, but there is an argument for emerging markets, because emerging markets are what they say they are. They are emerging, so they do not necessarily have a lot of industry. But what they have is raw materials. So if commodities are going to do well, it would make sense that emerging markets would go do well. But at the same time, you mentioned how cheap Europe is. Europe has been the second stepchild for quite a long time now. And there's some very discounted, good quality stocks in Europe. So I think we have as much of an argument for developed markets doing well as we do for emerging markets doing well. How do you feel?
I feel the same way. I do believe that it's a smart time to lean a little bit more toward emerging markets, as you said, than it is the developed markets. By definition, emerging markets should have a higher growth rate to catch up to the rest of the world. But again, you have to be careful if you're looking at a country like China that may have not see-through buildings, but see-through cities, where they encouraged these big corporations to move away from the larger cities, and they told them if Caterpillar came in and paved roads for them, they could charge a toll till they were paid back with their expenses. So that was a wonderful time for Caterpillar, but those cities got built prematurely, and they're very empty right now. So you do have to know what you're doing, or you have to hire somebody that's a real expert that knows what they're doing.
And you have to accept the fact that whenever you deal in emerging markets, you are taking on a higher degree of risk because they're emerging for a reason. And one of my clients said to me over the last few years, he says, you know, I've been so frustrated with emerging markets, but this was in a deflationary environment. He says to me, because they just don't seem to emerge.
Yeah, well, good comment. But about the time clients are saying that, isn't a bad time to step in and buy a little bit of it. You know,
if you have the stomach for the risk, yes, I
Rule
agree.
number 1 for clients is sleep nights, right?
Yes, sleep at night.
Okay, well, let's talk about recession. Is there a recession in our immediate future, do you think?
I don't think so. I believe with this pro-growth attitude of the new administration, and the fact that corporate earnings are expected to come out at an 8% increase when the fourth quarter earnings are announced, I don't see a recession as happening. Now, that said, we had a tremendous run-up in the market post the election and then post the inauguration. And my experience over the past 41 years is when you go up or down too fast in a short period of time, you tend to at least take a breather. So I wouldn't be at all surprised if we had a setback, but I don't see it as, oh, here comes the recession.
Sure.
I just see it in the normal course of events that it wouldn't hurt to take a breather.
And back to the value of tax-deferred accounts, if someone is nervous and said, gee, I sure made a lot of money in my last couple of months' statements, they can always raise 10% cash in their IRAs in case there is a pullback. And in that case, they have not at least stuck themselves with a lot of capital gains. So it's nice to have a lot of different choices in your arsenal for people that are fortunate enough to have part of their money in taxable accounts and part in tax-deferred accounts.
Right.
Okay, well, as far as the way that we can determine whether or not a recession might be in our future, there's the yield curve. So if we see the yield curve is pretty steep, we know things are okay. And then when you start seeing the short-term rates move up toward the same level as long-term rates, it's a warning. And when short-term rates are higher than long-term rates, that is a big-time warning that we could have a recession.
Exactly. But we're not seeing that at this time.
No. Okay.
But you're right. Those are things to keep an eye on.
Sure. And for people that want to be out on the golf course, they can have people like us worrying about that and losing sleep nights ourselves, and they can be out there relaxing and not worrying about it. But we like to tell people what to look for to know whether there's going to be some trouble. Okay, well, if we talked about the turmoil in D.C., and when you transition from one party to another, I mean, sometimes it's pretty smooth when the same party is in office, but that very rarely happens where you have 3 terms in a row. It's usually like it is now. Do you think the turmoil that's caused by that in this particular case would be short term or longer term, your best guess?
Ooh, that's a big question because Mr. Trump, President Trump, is a rather unpredictable individual. He's chosen a lot of fights to take on early in his administration.
Yeah, we talked about that.
And it is unsettling for the investing public to have this kind of turmoil. I really think that's a wild card right now.
Yeah.
I would hope that it would be short term, but I wouldn't be surprised if it becomes a longer term event. But yet, for 2017, I still see the market climbing higher throughout the year, but with the possibility of it being quite volatile.
Good answer, and that's why I brought this subject up. Again, going back to sometimes the markets tell us what's going on. We had a big rally, as you said, after the election. We've gone sideways for a while, and I think the market direction, if the market picks the direction of up into another good rally, that may be a sign that it's shorter term problems that we're going to be facing. And if the market continues to go sideways or breaks down through this trading range, then that's a sign that maybe these problems are going to be taking us right into the next midterm election, and we'll have a lot of turmoil for 2 years. So that's...
Stay tuned.
Stay tuned. All right. So let's talk a little bit about healthcare headwinds. Both candidates, one before the election and the one since he won the election, have been kind of jawboning the healthcare industry, the pharmaceuticals and the biotechs, saying, go ahead and spend $1 billion to find a cure for cancer, but then we don't want you charging enough to pay for it afterwards. So do you think that's built into these healthcare stock prices, or do you think that one person in Washington jawboning things will be able to prevent the healthcare companies from capturing enough profits to pay for their research?
Very interesting question, because on top of that, you have the aging baby boomers who have greater and greater needs for these pharmaceuticals. You have an administration that has been very bold about the fact that they want to cut regulations. So you've got 2 competing theories here going on at the same time. Actually, with the healthcare stocks having been beaten up so much in a deflationary environment, and now we have a pro-business environment that wants to cut regulations, I'm actually betting on healthcare doing better in 2017 than in 2016.
So am I. I'm encouraged by the fact that President Trump is inviting CEOs of all sorts of organizations. He has had the healthcare companies in. And I think they have to explain to him that if they want to be around to cure the next kind of cancer, they have to have enough money to do that research. And I've heard he's a good listener, but the market will tell us, I guess, right?
It will. Stay tuned again.
Sure. All right. Well, do you still want to avoid long-term bonds?
Yes.
Okay.
Yes, in fact, I'm having been through, as you have as well, so many movements in interest rates. I was a professional with Merrill Lynch back in the late 1970s and saw the tremendous run-up in interest rates, and then, of course, the peak in about 82, and then the fall back down. But if there's anything that becomes crystal clear, is that as interest rates rise, money moves.
Yeah.
And it moves out of bonds and it moves into equity. And I think we're at the beginnings of that right now, and I would still avoid long-term bonds.
Well, I recall that my wife brought a girlfriend home one day. I was stationed in Hawaii, still in the Navy, and she had gotten a divorce, and the broker told her to put all her money in 30-year bonds when yields were 8%.
Oh.
And a year later, they were 16%.
That's right.
And she said, she came to me and said, I'm getting nervous about these bonds. I think I ought to sell them and get my money back. And I explained to her that if she decided to sell after interest rates had doubled, she would get 50 cents on the dollar, because a 30-year bond is almost like infinity.
Yes.
And I said, so keep clipping your 8% coupons and hang in there, and things will be all right, but don't sell at this point. I still get Christmas cards from her, because at least she made 8%. And anybody that was lucky enough to buy a 16% bond in those days, it broke their heart a few years back when those bonds matured after collecting 16% a year for 30 years. But it took a lot of courage to step in there. But that shows you how horrible inflation can be. And I don't see anything like that on the horizon.
I don't either. No. At that time, we had the baby boomers entering the workforce, and they were buying houses, they were buying washing machines, they were buying cars. So you had a force that was driving this inflation. We don't have that today. The baby boomers are all retiring.
Good point.
And the echo generation coming up is not in that position to be able to bring that pressure to bear on retail sales.
Thank you, Pat. I'm going to wrap this up quickly now. I'm glad you stuck with us. We covered a lot of ground. I hope we helped you. Next week, Rob Gilfillan is the president of Sonero, which is an audio and visual and video conferencing company, will be our guest. It'll be a great show. Stick with us. As far as we're concerned, your money matters.